Hi guys, welcome back again to my channel for the financial accounting preparing financial statement practice assessment 2 from the AAT website. This is the part 2 of the video. I have already done another video which contains the first 3 tasks of this assessment, and I'm going to be doing the last 3 tasks because I don't want to keep the video for too long and suddenly people start losing interest on it. So it's easier to split that. The first part was mostly from the old advanced bookkeeping unit, but now this part is going to be mostly the final account preparation from the previous AQ 2016. But this exam itself, it's the new AQ 2022. So let's crack on with it because we've talked about so many other things about the exam, the timing, etiquettes, and everything there on the part 1. So please do check out that video. You'll be able to get some extra information about the exam screen itself and how we use it for using the references and the other options there. So I'm going to continue by pressing next, go to task number 4. This is the task I'm going to work from first. Okay, so let's look at that first task now. This task is about producing financial statements for sole traders and partnerships. This task contains parts A and B. So the first one they're talking about here, in partnership accounting, the current account shows the long-term investment in partnership. That is not right because normally current account is used for the tedious day-to-day transactions, interest on capital, interest on drawings, salaries, anything like that, where they'll go in the current account. Drawings will go in there as well. The capital account will show the long-term investment of the partnership. When the partner invests money into the business, that goes into the current account, and all their appropriation of profit, drawings, all the interests and other extra charges, they will go in the current account. So this one is incorrect. Let's say false here. The next one is financed by section of a partnership statement of financial position includes the balance of the partner's capital accounts and current accounts. That is absolutely right because that is your total capital employed by the partnership. That will be compared against the net assets of the company or the partnership in the statement of financial position. So that statement is true. In partnerships final accounts, the appropriation account starts with gross profit figure. So they're saying here, in partnership final accounts, the appropriation account start with the gross profit figure. I don't think so because gross profit is only before we have used all the other expenses to find the net profit, and the profit for the year is the one used on the appropriation account, not the gross profit. Therefore, that is a false statement. In partner's current account, interest on capital is debited and interest on drawings is credited to the account, which is wrong. Interest on capital is owed to the owner. Therefore, this will be credited to your current account, and interest on drawings is owed back to the business. It's more of a extra charge we pay for drawing goods, so money from the business. That is a debit entry into the account. So this statement is also incorrect. So here, one truth and other 3 are false. Okay, now let's look at the next one. Identify which one of the following describes net assets. What is your assets are? You're looking at net assets is equal to your capital employed. So not capital employed, capital account and your current account, or your like for sole trader, just the capital account will be compared against your net assets. Net assets means simply it's your total assets minus your total liabilities. So here it says here current asset minus total asset minus the current liabilities. It doesn't make sense. Current assets less the current liabilities is your net current assets. Current asset less the non-current liabilities. No, I don't think so. But here, non-current assets plus the current asset less the current liabilities less the non-current liabilities, that will be your net assets. So the answer will be the 4th one. Then the third part here, the purpose of the statement of financial position is to examine the cash position of the business. That is done by statement of cash flow. You learn that in your professional diploma accounting course, which is your level 4. Ensure the debits are equal to your credits. That's your balance. Nothing to do with your financial position. Show how profitable the business is. That is your statement of profit and loss. And then the last one, give a snapshot of organization's assets and liabilities at a particular point in time. Yes, you're comparing your assets, liabilities against your capital. So that is the right answer here. So example, this fourth statement is the right one about your statement of financial position. Then they're talking about Lucy runs a jewelry gift shop. And she's a sole trader, the year ending on 31st of March 2018. You are given her trial balance as of 31st of March 2018. Okay, 20x8. Okay, it's fine. Here you have the reference, because if you click on the reference, you'll have that information here, which you use to do further entries down. So now I'm just going to go here to check what we have now. We have statement of profit and loss already been calculating with a profit of £33,054. During the year, Lucy made personal calls on her mobile phone. The total cost was £180, including VAT. This information can be viewed in the reference section on the right there. They want you to do a complete a pro forma journal below to account for this. So here, in her work phone, the cost of personal calls are for £180, including VAT. Therefore, we have to consider this as, what do you think? Drawings, isn't it? Because for the business, she is different than the business. Therefore, all the personal calls made from a mobile phone has to be classed as drawings. So I'm going to say drawings here, and then I'm going to debit this into the drawings account. And because it's been already calculated with the profit and loss here, I have to assume this was part of the expenses here. For example, for the phone, let's see here, it's been charged under any particular expenses. I'll say other expenses. Okay, here I have to say probably this is other expenses. So let me just check it anyway, just to confirm, to make sure I have the right info. It doesn't show mobile phones or anything like that here. So, but in the here, if I'm going to look at it, there is an option for mobile phone expenses. So when we really charged it, I think it will be going under other expenses after they have collated all of them together. But in fact, initially, this was recorded as the debit side of my mobile expenses account. Because this is including VAT, we'll find £150 would have been debited into the phone expenses account. So I have to take that away by crediting it. And then obviously you're going to look at the VAT account, because there is VAT applied on that as well. So I'm going to find the VAT. I'm going to credit this for £30 as well. Okay. So what you have to remember here, this was initially charged into the relevant account as that much. Since it's for private usage, we remove it from here and we will debit that into the drawings account, because this is how it should have been. Okay, Lucy not meant to charge this into the business account directly, because it is for a personal usage. Following the inputting of this journal, calculate the revised profit for the year. Out of these three, only this one will make an effect on my profit, because now my mobile phone expenses now reduced by £150 by crediting it. When I done that, I also increased my profit from £33,000 £33,054, increase that by 150. That gives me a new profit figure of £33,204, because now the expenses has gone down. Therefore, my profit is going to be increasing. They also want to know what is your capital account for the year. So what now we have to do? We start with the opening capital of 24,580. So this one I can use the reference bit here. Let me move it around a little bit here. Now, if I look at it here, I'm going to have a capital account. So we're going to start with balance board down. Figure of capital was 24,580, because this was the opening balance, 24,580. And then also the drawings for the year now has come to a different amount. Remember, there is an amendment for drawing as well, £180, isn't it? So therefore, we go here looking at the drawings account, 28,776, 28,726. Add the £180 to this. That gives me a new drawings amount of £28,956, and the profit for the year will be going on to the credit side, which is £33,204, and that leaves me with new balance carried down profit figure of minus 57784 is equal to £28,828. This is the new profit figure for the next year. No, not profit, the capital figure for the next year. This is the closing capital for this year, and that will become the opening capital for the next year. All right, so that is very important. You get to that understanding because that drawings also changed because this transaction created another extra £180 into this drawings account. So now what we're going to do, we have to fill out the statement of financial position for the company. But in this scenario, what you also have to remember, all of this going to be equal to your new balance of 28,828 because your capital will be equal to your net asset figure. So let's prove it by going into the reference. Find the reference, leave it here, and then we will be able to start typing that information accordingly. So according to this, the non-current assets are now, it's your fixtures and fittings, which is 6487. They didn't say anything about in decimals. No, they are completing their SFP down with the net asset figure. Yeah, that's it. That's all you have to do. There's no decimal figures expected there. So let's fill out with the information we have. So the accumulated depreciation is £4,255. Therefore, this amount is going to be having a new carrying amount, 86487 minus £4,255, 2232. So we have that figure here. What are the assets I can find out here on the current asset bits? Current assets, one of them is going to be my closing inventory. Then you also have bank. It's a debit figure, so there is definitely an asset, current asset. Then you're also looking for receivables ledger control account. That is also an asset, so I'm going to select that one. They're the three assets I have come across so far. Do I have any other assets from here? I may found it, but at the moment, leave it for it. We'll select those information. We will close the here, and we choose. Get rid of the highlighter there. So we have bank, closing inventory, which is going to be your inventory here. And then last one is going to be your RLCA. So receivable ledger control account or your trade receivables. So trade receivables here. So the bank is £35,042. Inventory is going to be valued at closing inventory. Closing inventory is valued at £11,424. £11,424. And then your trade receivables standing at 14,442. £14,442. Okay, so that is the amount. Then your liabilities currently at the moment we have payables ledger control account. Yes. So it's going to be trade payables. And then also do not forget the VAT. There is a VAT here. But now, when I thought about VAT, straight away something came into my mind. Go up here, there is an entry into VAT for £30 on the credit side for when we made the adjustment for that drawings. So what we're going to do, we need to make sure the VAT is updated with that £30 here. That will give you 3498 as that figure. So let me put 3498 as the new amount. And the trade payables also going to be standing at £30,814. So £30,814. Okay. So here, now we have completed all the boxes accordingly. Let's find out what is my net current asset. Net current asset is going to be 60,908 minus 34312, which is my non-current current liabilities. That gives me 26,596 pounds. But then if you add that together with that 2,222 pounds, 232 pounds, I will be getting a new amount of 28,828 pounds, which is equal to my closing capital. Here, they're trying to find out this is your net assets equal to this closing capital figure. So let's go back and confirm it. This is my last figure for my capital. That is equal to my net asset figures of 28,000. 828 pounds, and there is no decimal expectation here, so I'm going to leave it as it is. There is no decimal expectation here. I'm going to leave that as it is as well. And they also didn't ask anything about decimals in any of it, so we're going to be ignoring decimals completely on this question. Now let's look at the next question. Let me answer it, and then let's move on to the next question. So here they are asking you the task about interpreting the financial statement using the profitability ratios. This task contains part A to D. So the first one they're asking you, identify which two of the following are considered the primary users of your final accounts. Primary users, secondary users, auxiliary users. There are so many different types of users, but for you, the primary users are who's going to look at it more often. An existing investor, it is not about somebody I'm going to think about as straight away. Of course, they will be careful about this one. Lenders, on the other hand, also will be somebody. Employees, I don't know. They will be classed as what is that again? Anyone care about as a primary users of the final accounts? Lenders, yes. Customers, they have no reason to look into your final accounts because they're not lending you anything. They're trying to buy goods from you. Do you look at the financial statement of Tesco and Asda before you go and shop in there? No. So it's not about primary users. People may argue, government, why the government can't be the primary users? Because for you, the government doesn't come and sniff around your final accounts unless they know you're doing something dodgy. Investors or the lenders, on the other hand, they are somebody who looks into that a lot because they want to know whether it's best to invest money into your business, or the lenders to see whether you can settle their debts in order. Government only cares about your returns. As long as you pay your VAT, you pay your tax, they're not going to be looking at your accounts on a particular way. They will look into that as an auditor in case there is something irregularities there. There may be a whistleblower or some complaints about the business. Of course, they're looking into that. What they don't look at it as a primary user. Now, let's look at the next one here. Identify the accounting principle being described in each of the following definitions. First one is sales revenue should be considered when goods and services have been supplied. Okay, so give me a second, please. I'm just going to check quickly something. Teams quickly. Okay, device settings. So when I'm looking at it now, there is some problems with the array, but here you go. That's fine. I thought there's a problem with the microphone, so it is not. So it's absolutely fine. So I just worried whether it's no no video recorded with sound there. So I'm making sure that is not the case. Let's look at the next one here. The identify the accounting principle being described in each of the following definitions. Okay, so let me full screen it. Sales revenue should be recognized when the goods and service has been supplied, costs are incurred when the goods have been received. So accounting principle for that one is going to be your accruals principle because it's when they have happened, not when you paid for it. Okay. Financial statements are produced using the assumption that the entity will remain in the business for a foreseeable future. That is going to be your going concern. We expect the business is going to be operating for foreseeable future. Transaction and the valuation methods are treated the same way from year to year, period to period. Users can accounts can therefore make meaningful comparisons the financial performance from year to year. So for me, it is more of consistency, isn't it? Because you keep that consistent, so you don't change how you operate your what do you call procedures. The last one for the lease is going to be profits are not recognized until a sale has been completed. In addition, a cautious view is taken for future problems and cost of the business. They are provided for in the accounts as soon as the reasonable chance of such cost will be incurred in the future. So this is what we act with prudence. Prudence is something you set off something like a allowance for doubtful debt. It's a prudential thing. What do? You set off part of your trade payable or receivables as doubtful debt, just in case some of them might not be able to pay for it. And then also it is, the profit is recognized until the sale has been completed. So it is more of a prudence accounting principle. Now look at this true or false statement. Identify whether each of the following statements are about the profitability ratios are true or false. So let's look at this now. The part they're talking about, the analysis of financial statements using the ratios provide useful information when compared with the previous performance or the industry average. Yes, makes sense, isn't it? Because you're looking at with some other competitors or somebody with the industry, and then also your old performances from the same period, another what do you call it, time of a different period. So that is true. An organization's management will never use financial ratios to assess its performance. That's wrong, because you will say will never use. That's wrong. They may use, may not use, but you never say will never use. That is completely a wrong statement. Ratios based on historical data can always predict the future performance of an entity. That is impossible. If you say always predict that, everybody will just using ratio. So therefore, this is not the right answer, because the word always straight away trumps every other option. It will simply say there's no other option there. So that is wrong. Okay. Now let's look at this one here. They're giving you following information about an organization. The statement of profit and loss shows following figures: sales revenue, gross profit, profit or loss for the year. They're all positive there. In that case, it's a profit. Statement of financial position shows current liabilities, non-current liabilities, current liabilities, and the capital, and these amounts there. They're asking you here, complete the following ratios based on the information above. They want it in percentage. Show the answers to 2 decimal places. Return on capital employed. Return on capital employed is calculated as your profit or the loss for the year divided by your capital employed. Your capital employed is equal to your capital plus any non-current liabilities you may have. So here I'm going to divide 79,350 divide in brackets. I'm going to use 116,210 pounds plus the non-current liabilities of 17,600 pounds. That is your probably a long-term loan there. And I'm going to multiply this by 100%. So I got a return on capital employed at the percentage of 59.30. 59.30. That is the return on capital employed. The next one is net profit margin. It's calculated against the sales revenue, your profit or loss for the year, divide by the sales revenue, multiply by 100. That'll give you the net profit margin. So here it is straightforward: 79,350 divide by 429,120, multiply by 100. That gives me 18.49%, where it is to 2 decimal places. That is 4 marks for these 2 questions. They also given you a new one here. You have already calculated the selling expenses against the revenue percentage for the year as 15.6%. The corresponding figure calculated from the last year's account was 13.2. They're asking you here, the selling expenses to revenue percentage shows an improvement or deterioration. So that is the meaning of it. That means if your percentage is higher, that means your expense were higher this year than the last year, because therefore I have to say my percentage has deteriorated because my percentage is 15.6 this year. That means I had more expenses. Last year was 13.2, so I had less expenses compared to my sales revenue. My expenses are higher this year, so we will call that a deterioration of your what do you call the percentage. It has basically got worse. So if it goes to 30%, even worse. But if that says 10%, that means that improved. Identify what effect, if any, each of the following scenarios have on the ratio stated. Each scenario is independent, so they have nothing to deal with at each other. Scenario 1, your company has managed to negotiate a lower price with the main supplier of your inventory. This has not affected the quality of goods you receive. So your cost has come down. Lower price means it's going to be higher profit. If there is going to be higher profit, your return on capital employed is going to be increasing, isn't it? It won't change anything else. Your capital employed, your capital, your long-term liabilities, they're not going to change. Only your profit is going to change. If your profit is increased, then obviously your return on capital employed is going to be increasing. They are also asking the cost of sales as the percentage revenue. It's going to come down, isn't it? If your cost of sales is going to be like lower price, your cost of sales also going to be lower. Therefore, percentage against revenue is going to be decreasing because your cost of sales is going to be a smaller amount. So that is going to be an improvement on that ratio. Look at the next scenario. The wage rates of administration staff has risen in line with others in the industry. What is that going to do to my gross profit percentage? And remember, this one, it's about administration staff. Therefore, it will not impact my gross profit percentage because they're not part of my cost of sales. Cost of sales is going to be mostly your wages for the people who are working in the production line or in the service. Administration staff are other expenses. Therefore, it will not affect your gross profit margin, but your net profit margin will decrease because your rate is increased. Therefore, your profit is going to come down from the net profit side. Net profit is changed, means your sales revenue is going to remain same, but expenses is higher. Your net profit is going to be increasing. So let me answer it that. Then now let's look at the next one. Task number 6. It's only for 12 marks here. We're almost at the finish line. Let's discuss this and then we'll finish that video in a positive manner. So let's see this. This task is about preparing records from the incomplete information. This task contains part A to C. Ian printed a report from the accounting software system. The report suggests his closing balance for product TP12 was 368 units, valued at £1 per unit. TP2 is a small component. It's a small item. An inventory count revealed Ian had 378 units valued at £1 per unit. So here the report shows we have a lower unit than the physical count. Physical count, it's simply saying we have more. So they're saying here theft of inventory by the members of staff. That is impossible. Why? Because we have more goods in the physical count. We have less in the software, more in the physical count, so that could not account for it. Let's look at the next one. A purchase credit note had been entered twice in the accounting system. So that means when I send a credit note, that means it reduced the inventory items. But if I enter it twice, it's going to reduce more in my paperwork. So that is possibly a reason because I may have entered it 10 items returned twice. And that way, the physical inventory is going to say 378. My software is going to say 368. So it is possible that could count for it. A box of TP2 has been omitted from the inventory count. That is not right because if you omit it, you should show a lower amount. In this scenario, we have got higher amount that's not account for. Now, last one, a production had returned a number of components unused, but this has not been recorded. So that means we have been received those goods back into my books, into the inventory itself, but this has not been recorded, means it's not gone in my account software saying we have received the goods back. So it is true, it could count for this particular scenario. All right, so you just have to be a bit careful with it. When you have this kind of a questions, always give the logical choice right. You see, so many questions are here based on logic, not much calculation for you to be worrying about. If the closing inventory reported was too high, this could lead the gross profit to be what? If your gross closing inventory is high, your cost of sale is down, gross profit is going to be overstated. And also what's going to do to my current asset? It is also going to be overstated. My closing inventory will be my current asset at the end of the year. As my statement of financial position suggests, both will be overstated, will be the answer. So now let's see, we got a few more to do and then that's it. We are done and dusted. You're preparing the accounts for sole trader and have given the following information for the year ended on 30/06/2018. Sales including VAT is 76,080. Your client using the profit margin of 30%. So remember, when it's margin, your sales is your 100%. Your profit margin will be 30 and 70% is your cost of sales. That is how you do. If it's a markup, your sales revenue is whatever cost of sales plus the markup, and then whatever percentage is going to be there. Cost of sales is going to be classed as 100% when it comes to markup. So let's look at this one. Sales revenues VAT were 76,080 pounds. Your client uses gross profit margin of 30. Purchases excluding VAT for the year is 48,390. The inventory as of 1st of July 2017 was 5,050. They want you to calculate what is the sales net of VAT. So let's calculate it. How to calculate it if it's including of VAT? I'm going to divide it by 120 and multiply by 100. That is how I'm going to find what is the net of VAT. Or divide by 6, multiply by 5. You do the same way, you will get a value of 63,400 pounds. That is the amount I'm going to get here. What is the cost of sales? If you know your gross profit margin is 30%, cost of sale is going to be 70% of this net sales value. So therefore, I'm going to multiply by 70%. I'm getting 44,380 pounds now. And then they also want to find what is the closing inventory at the end of the year, 36/2000x8. You have to remember the formula for this one is going to be opening inventory plus the purchases minus the closing inventory is equal to your cost of sales. In this scenario, if you swap the figures around, basically put the closing inventory into the other side of the equation, because it was a negative figure there, it will become a positive, and the cost of sales, bring this side of the equation, that will become a negative number. So I'm going to add my opening inventory, which is 5,050, plus my purchases is 48,390, minus my cost of sales, which is 44,380. It gives me 9,060 pounds, which will be my closing inventory value. It didn't say anything about decimal figures on any of these questions. I'm going to stick to writing the whole amount. Another one is another client, Melissa Rose sells dolls for 48 pounds and previously purchased the dolls for 40 pounds each. She is not registered for VAT. Complete the following statement. That means she has either a margin or markup of 20%. So let's find out both. So think if it is a margin, if she sells this for 48 pounds, if you to have a 20% of margin, that means your cost of sales is going to be 80% of this amount. So let's see, 48 multiplied by 80%, that gives me 38 pounds 40 pence. It is not, because the cost here is 40 pounds. Therefore, this cannot be a margin. But think if it's a markup. If it is a markup, this is the 120%, because this is 100%, this is going to be 120%, and then I'm going to divide this by 120, multiply by 100, and I will say the cost in that scenario comes to 40 pounds. So that means this is simply a markup. Then prove it. Look at this. Cost of sales, or the purchaser's cost, is 40 pounds per doll. So therefore, that is the 100%. Multiply by 20%, which is the profit. We add to that one, which is £8, and then add those two together, and then I will get a full marked up selling price of £48. So this is definitely a markup. Now I'm going to answer this one, and it's taking me back to question number 1, 2, and 3 because I didn't complete it in this one. I did do in my part 1 anyway, but I'm going to be good. I'm just going to say thank you, but no thank you. I will go and trying to submit this assessment now. So I'm going to answer it. There's nothing to change here. So I'll go here, get rid of the reference, and then I'll press submit. It says that you have answered only 3. Let's submit the answers. Let's see I get good marks on the task 4, 5, and 6. So I have full marks for this one, full marks for this one, and I also got full marks for this one. Thank God for that. I didn't embarrass myself a little bit there. So that's not bad, guys. So that should conclude part 2 of the video. Please make sure go back and check part 1 if you want to know the outcome for the first 3 questions. And I wish you all the best and good luck with your exams. I'm looking forward to making more videos in coming weeks, especially for MATS units. And hopefully I can do something with the taxes because I haven't researched much about tax yet, but I'll be doing that one later on. There is kind of a contention I have to do about the business awareness unit because that is more theory based, and I probably can't talk about a lot on there. But writing and typing answers while we're doing the videos, it's not going to be that much feasible. But I'm going to see what I can do publishing that video soon. So anyway, guys, I'm going to say goodbye to you, and hopefully I'll see you guys later on. And let me see whether it let me get out of here. Give me a second. Yep, that should be fine. And then yeah, guys, wish you all the best. Take care, and I'll see you all later. Bye bye.